After a brief respite, we have Professor Mark Guthner back for office hours, and we're going to take some questions, if you have any, and talk about the things that we're taking a look at today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. I am joined today, happily, by Professor Mark Guthner, who I believe was out of town visiting his alma mater, University of Michigan. Is that right?
It was. It's interesting. Even at my ripe old age, I think there's three or four professors that I studied under. There's three that are still there. One was retired emeritus, Professor David Brophy, who I wrote a paper with while I was a master's student, and he did something that was a lot of fun called the Growth Capital Symposium, where we would invite, as many startup companies, growth companies that were available, and then invite a large number of venture capitalists. And this would be usually a 2-day event where we tried to help arrange, startup companies and growth companies match up with money. And so it was a lot of fun. It was fun to get back to see him. And
Is there a big pipeline from Michigan, from Ross School of Business to venture capital?
I don't think there. I don't know. When I went to school there, venture capital was very small. And then about 15 years ago, he kind of morphed into more private equity because that was becoming a bigger deal. But the classes were super popular. He said his typical class was 90 students when he decided to finally retire. So
it was interesting when I was speaking at the Money Show conference in Sarasota a week ago. I had the opportunity to interact with a number of the attendees. And, you go to these conferences, and every conference sort of appeals to its own unique demographic.
yeah,
And one of the things I observed about the Money Show is that the demographic skews a little bit older, a lot of retirees, or at
yeah,
least this was in the panels that I participated in. And something I heard on more than one occasion: what brings you here? Where are you from? People were from all over the country. And, I'll just speak to one of the folks that I spoke to who had come from Detroit. He was in the commercial HVAC business, so they installed,
hmm
heating, ventilation and air conditioning systems in commercial buildings. And he had sold his company recently to private equity.
yeah,
I spoke to somebody else who was in the fitness center business and is about to sell his business to, lo and behold, private equity.
yeah,
And it got me thinking because there's a cleaner that I started to use that's local to me, and I'm inclined to go and ask them, is this owned by private equity? Because I'm beginning to wonder just how many small businesses that we interact with regularly truly are small businesses, and how many of them have been snapped up by private equity.
yeah,
And I'm guessing that the number is fairly large because, traditionally, as small businesses, people would retire. They would sell their companies to somebody else who wanted to be a small business person. But the advantage that private equity has when it comes to buying small businesses is that they don't have to have any creative financing typically. The financing issue has already been resolved, so
hmm
they can just walk into a dry cleaner or an HVAC or plumbing business and just say, we'll write you a check.
yeah,
You don't have to worry about, the new buyer, needing years to transition and seller arranged financing and things of this nature. And, the dynamics of this are fairly interesting to me, but one of them is that it means that, in big lump sums, pools of capital are being introduced into the publicly traded securities markets as people sell their small businesses. So private equity's money is ultimately, these guys get their money. Oftentimes they're retiring. They're not going and buying another business. another small private business or creating a new one, they're just investing in stocks. The money
Yeah.
just sort of flows directly into the equity market. So as a pool of investment capital sort of working its way through the system, I just thought that was fairly interesting.
Yeah, I'm not a big fan of private equity. I've never really had what I think are good experiences, either as customers or relatives that have sold their businesses. They often get a very nice deal, sell their medical practice, dental practice, all that kind of stuff. But my cousin sold his practice to private equity, and
A medical
yeah,
practice
it
or
was
a dental
a dental
practice?
practice.
Mm-hmm.
And then they got into some kind of scuffle or whatever, and he was let go, and he didn't really care because okay, he'll go open another place.
Mm-hmm.
Because there's a limit to how much they can stop you from working, and he couldn't. His contract said he couldn't move. He couldn't open another dental practice within 20 miles, which is fine. So I went after he
Mm-hmm.
let him go. I didn't. He wasn't set up anywhere yet, so I went back there to get taken care of. And I just got really annoyed because they just kept sending me bills. It's like, what
Huh.
is this for? Well, I thought I paid this. Well, you had to pay some more. And then it's like, just like to get another bill. And it's like, so I was very pleased when he opened um, another practice, except for the fact I now have to drive an hour and a half to get to my dentist. Uh, but he's a great dentist. Is like he's a really really skilled guy. Does great work. So I put up with it and do the long drive down the Jersey Shore to go find him and have him and take care of my teeth. But and then I kind
This
of a
is
lot of restaurants they get taken over and then they lose because so many private equity is really driven by finance people and not by entrepreneurs
mm-hmm.
that they're looking for places to you know cut costs and if can they reduce quality. They say they're not reducing quality, but of course they are reducing quality when they buy various things, and they rejigger their product line and try to find cheaper ways to make the product. I'm very interested to see what happens to Panera Bread now that they have gone private equity, and if their new owners will make it a nice restaurant to go to for a quick, inexpensive meal. Although I do notice prices went up, but I don't know if that's because of private equity or the fact that everything has gone up. You know,
Mm-hmm.
McDonald's is it's like kills me. I haven't been into a McDonald's except for breakfast in years, and because I typically don't frequent those places. But the price of meals of there what doubled in the last 5 years, and um, doesn't seem to stop people because by me there's always a line at the
I
drive-through.
think I think it's a hard habit to break in the sense that people develop a routine
Yeah,
and they become comfortable with that routine and probably the operators are vaguely familiar with that and they have a good gauge of the elasticity of demand
yeah,
and are able to affect price changes consistent
yeah,
with that. And then of course, as you point out, I think there is a sense that inflation is affecting everything because we go to the grocery store, the prices
yeah.
are clearly there. People have gone, and if you've gone to the grocery store and you see that a dozen eggs, which once cost you $1.99, granted we had some short term issues related to avian flu and so on, but you go in and you see, okay, a dozen eggs cost me $12. You go to get your egg McMuffin at McDonald's and they're saying it's $5. You're like, well,
That's why.
I mean, I can kind of see where that's coming from
Yeah,
because a half dozen English muffins is $6, and a dozen eggs is $12, and there's a piece of cheese on it and a sausage or this or that, and so I think that the expectation of the consumer has been affected by the prices that they themselves have seen change
yeah,
at the grocery store. Now, I don't know that they're moving in lockstep, Now, with respect to Panera, this is an interesting one because that was a rapidly growing chain. It was quite
Yeah.
popular, and then for a host of reasons, it became less so. There is another sort of business dynamic that's been going on, which is the consolidation in the food supplier business as
Um,
well. So Cisco Foods, Sysco, not
yeah.
Cisco. They're a big supplier. U.S. Foods, I believe, is also another big supplier.
Hmm.
I was speaking to a friend of my wife's. Someone that she grew up with. She went to high school with. They own a restaurant in New York, and I haven't yet had an opportunity to delve into it. But I was very curious to see, whether whether the food suppliers that they've been using, whether they've observed any change in the quality of the food that they've been getting. And the reason is because in many cases, the food suppliers, the restaurant food suppliers, their names may not have changed, but they have indeed been absorbed by larger conglomerates. And in that process, you can imagine if you were ordering something that now everybody's basically getting the same thing. And I've been wondering myself whether that has had an impact on the quality that you get at some of these places, and I suspect that it probably does.
Probably does.
Anyway, I thought there was a couple things that I thought we might talk about today. One of them relates to something that you were involved in. You and I touched on this earlier because I know you did. When you were a banker, you actually handled financing for some of these types of businesses. I happened to mention yesterday Southern Copper on the open mic live stream. It is a stock that we own. In one of our funds, we have 310,000 shares of it. And what I was particularly interested in is that, historically, when I thought copper and I thought copper miners, I just automatically gravitated to Freeport,
Yeah.
Freeport-McMoRan. We don't own Freeport-McMoRan. We own Southern. The reason we own Southern is just that I've observed that their operating margins are so much broader. Let me just show you quickly what I'm referring to on the screens here. So Freeport's margins are, about 8.5%. I think this is their adjusted net income margins. Yeah, okay, so I remembered that correctly. So this is the number I'm looking at right here, 8.5%. That's the anticipated for the full year. Expected to broaden, which I guess we would also expect because copper prices have actually, all else equal. Look, if copper prices rise
Yep.
faster than every other cost you've got, your margins are going to go up.
Yep.
It's pretty simple. So, and none of that seemed unreasonable to me. Like an 8.5% adjusted net operating margin for a miner going to 12, that's all fine. Then I looked at Southern Copper, and I thought, this is a mature industry. What is going on here? Their margins are 32.2 going to 33.6.
Oh, that's
I mean,
sweet.
that's not like a modest difference.
That is
It's
sweet.
Yeah, I mean, I was thinking, does it really cost them that much less? I mean, these are businesses that sell commodities.
Yeah.
So it's not like, oh, Southern Copper's copper is just, it's so much better than Freeport-McMoRan's copper. I mean, copper is copper. So I was curious because you had told me that you actually did finance for miners at one time. You want to give us a little bit of history on that
Yeah.
and what your thoughts on this might be?
Well, there is a, let's call it a cost curve. There's the low cost producers, and clearly Southern Copper is now the lowest cost producer on the planet. Back when I used to do this, Freeport was the lowest cost producer. And interestingly, the copper mine at the Grasberg mine, which is in Irian Jaya, Indonesia, it's the eastern part of Indonesia, next to Papua New Guinea, for any of those that know Southeast Asia, is essentially a mountain, and the mountain is a big pile of copper. And it's really a heck of a story about how they created this mine, because they essentially had to build roads to get to the top of the mountain, and then they just started drilling down and taking the copper out. The copper was so dense in the soil that it was the lowest cost producer in the world, even though it was a tough production. But they also produce, which is common with copper mines. There's typically silver and gold are typical co-metals that are mixed with the copper, as is molybdenum, so which is a hardening element used in stainless steels and stuff like that. Um, Turns out when we were financing Freeport when I was at ANZ, this going back a lot of years, 10, 15 years perhaps, they would pull out and sell separately copper, gold, and they would, I'm sorry, gold, silver, and molybdenum, and sell those as trace metals to somebody else. If you use that as a credit against expenses, that essentially drove down the price of copper production to something, depending upon the year, between 0 and 25 cents a pound. It was like pulling
Mm-hmm.
the copper out of the ground almost for free. You looked at it, and so when back in those days, copper was 2.50, $3 a pound. Naturally, these guys were making a ton of money. Now, there's lots of other copper mines where the cost of production is 2, 3, $4, and um, and so when you invest in copper mines, it's best just to go to the lowest cost producer because there's going to be inevitable downturns in the price of commodities. And if your cost of production is $4, you're going to go out of business if the price of copper dips. So mines like that kind of look like options. That if the price takes off, they go from not profitable to very profitable, and they start minting money, and then the price of copper falls, and then the profitability disappears. But um, if you're looking at the lowest cost producers, they're going to still make money. They're just going to make less money. And that's really all that we did at ANZ. We probably financed the 10 biggest miners in the United States or in the world that were low cost producers, people like Rio Tinto, BHP, well, which is a huge Australian miner. That's where the bulk of our business was going. We do some smaller operations that had a lot of promise, but we kind of stepped with the big ones.
This is a chart that I have on the screen right now that I showed yesterday in the context of just my thoughts on
Mm,
copper. 1 metric ton of copper divided by the price of 1 ounce of gold. So basically, you can think of this as the copper gold ratio.
yep,
It's one way to think about it, and it's essentially at, well, I don't know about all time lows, but
pretty
it is
close.
certainly at the lowest level that we've seen in the last 35 years. And this is not surprising. We have, um, governments have been increasing their gold reserves. Central banks have been increasing their gold reserves. There is plenty of investor demand for gold and silver, both up sharply this year. I saw somebody speculating over the course of the weekend that they actually thought that gold and possibly silver might return as, legitimately as forms of money.
I would hope
Now I don't
so.
know if that's true or not. It seems like it would be very difficult for fiscally unrestrained governments to go along with something like that, and therefore I would imagine that they would resist it immensely.
Well, I don't think it would
So,
succeed. The problem is if you're going to back your currency with gold, the governments have to run balanced budgets over a business cycle. They get a little bit over their skis and they borrow some money, they got to pay it back. Otherwise, the interest expense is just simply too high because you're just not writing new pieces of paper to pay off old pieces of paper. You got to go find some gold and hand it over to somebody. And so those
mm-hmm,
systems always break. And that's why we went off the gold standard in the US is um, the US government was running chronic deficits because of the Great Society programs of the early 60s, plus the endless wars of Korea, Cambodia, Vietnam, and all these things. And they were printing more money than they had gold for.
Yeah.
And then governments, particularly France, I think it was de Gaulle, said, "We don't want your treasury bills anymore. Here's your bonds. Give us, and we're turning this into gold, and we're going to ship that gold back to France."
Mm-hmm.
And that's what brought the Bretton Woods Agreement to a halt, because everybody knew that the U.S. government didn't have all the enough gold that say backed all the currency. You couldn't turn all all the currency in and get gold. There was going to be a shortage and a default. So then once France did it, everybody else joined in and said, "Hey, that sounds like a heck of an idea." And then that's what forced
A run on the
a
bank.
run on the bank. That's right, the good old fashioned run on the bank. You know, the fractional reserve banking, fractional reserve anything is a dangerous game of confidence. And as soon as the confidence is gone, the tower falls.
Yeah. Tucker D. Dog makes a comment about Panera. Well, first he says, "Do you guys anticipate a rate cut tomorrow? And what is your opinion on what happens if there is versus is not?" Um,
It's
I think we can get to that right after I make the following observation about copper, which is that copper obviously has important industrial uses, and if you believe in the build out in data centers, these things are used obviously in this process. If we're going to build more electrical generation, presumably we're going to have increased copper demand. So my thinking is that it's good to start spreading your chips around with respect to the metals and not just precious metals. I mean, actually, it's interesting because platinum also, I thought, which is rarer and also has industrial uses, is rarer even than gold. Arguably, platinum prices should be a little bit higher because I think the platinum gold ratio, I don't have it handy, is also a little out of whack. That is to say that gold is elevated relative to platinum prices. But yeah, I thought it seems like copper is a decent place. You can invest in a business that's actually making money. In this case, Southern Copper is making a lot of money at current prices and not unreasonably valued. Just to get back to Southern Copper really quickly before we move on here. What we're looking at is, let's see, what do we got? These guys are trading at, well, they're looking to make, just shy of $6 a share next year. 574 is what the consensus is. 141.35.
Are you?
So that works out to 20, a little over 24, almost 25 times forward earnings, but earnings growing at, and this is the slowest rate of growth anticipated, but growing at 11%, which is probably faster, I would expect, than earnings growth for the S&P more broadly, which probably is going to see, I don't know what you know what the forecast for S&P earnings growth is next year?
I do not.
I mean, I usually use as a rule of thumb, like, probably 6 to 8%. It has more recently been growing. The compound annual growth rate's been higher lately, but part of that is skewed by the big winners. You got Nvidia out here making, adjusted net income margins of over 50% after taxes, and which is just incredible, and that just sort of throws the whole thing out of kilter.
Yeah.
But I don't know. What do you like to use as a rule of thumb, as a heuristic for a long-term compound annual growth rate assumption for the S&P 500? Let's say
I look at the nominal GDP growth rate is kind of my number, and then is there a reason for it to be faster or slower in the short term? But yeah, that's what I use for a growth rate, what I think nominal GDP growth rate will be.
I use that as my top line assumption, and actually I usually figure that it's probably going to be in line with GDP growth or the real rate of inflation,
Hmm.
whichever is higher.
Yeah. Well, it could be right,
So,
because there's implicitly with my approach is I'm just assuming margins stay the same,
hmm
right? So if revenue grows by 7%, margins are the same. Profits are going to grow by 7%. And then you look for reasons why maybe companies are becoming more efficient or not. We were talking about this before we got started, but I think this is an interesting issue is that, PE ratios are elevated, especially when you look at the CAPE, the cyclically adjusted PE ratio.
hmm
I think it's, in the what, mid 30s now. I don't know if Bloomberg will tell you that number.
Yeah, I'm sure
Um,
we can probably get it. By the way, Monday Morning Quarterback says Southern Copper strong buy per seeking alpha quant analysis. And look, just as a quick point on this, we own it,
mhm.
right? So we own it in one of our funds. We've got about $44 million worth of Southern Copper, 310,500 shares of it. So I'm not, it's not like I'm just saying, oh well, here's a loose thought out there. Maybe one could consider this. I mean, we are in it,
Yeah.
in one of our
There was,
discretionary
they've got so much going for them
funds.
right now because I'm sure they're also um, pulling up a little gold and silver with their copper. Price of coppers, there's a huge tailwind there because of
hmm
the additional build out of the electrical grid that's going on to power all these AI facilities. So there's plenty of
So this is
demand.
yeah. So this is the interesting part, right? So the street overall has very sort of negative views of it, but
Hmm.
it's really very different perspectives on it. Now we've owned it for a little while, I should say. Um, today, today is the 9th. Yesterday, we have this update from Alejandro de Michel. Let's see over here, de Michelis at Jeffries, and he actually came out with a buy on it yesterday. He is rare. In fact, I will just so that people who are not familiar with the screen get a sense of it. This number right here, this 2.73. So this can be a number, I guess, basically from 1 to 5, 1 being the lowest, 5 being the highest. Um, this is essentially a measure of the overall bullishness of sell side analysts on the stock. So and maybe I can get a hold of some of the research from some of these guys. I probably can. We deal with many of the primes, so I should probably ask about this. Um, but we definitely have some different views. Jeffries they came out with a $175 price target, and that price target was updated yesterday. Meanwhile, Scotiabank, Alfonso Salazar, he comes out with a $90 price target on the exact same day. This is quite an interesting dynamic.
Yeah.
Um, Now, another thing I want to point out about Southern Copper is that Southern Copper, it's basically a subsidiary of Grupo Mexico,
Mm.
and so what the reason I bring all of this up is that when I was looking at the copper trade, I liked it. Freeport McMoran, normally the place I think about it, start going through it and saying, well, wait a minute. Southern Copper seems to have a much lower cost of production, and in the commodity business, that's everything,
Yeah.
right? Because um, as you think about it, if the commodity price starts to fall, of course, all of these names would drop if and as that happens. So that's the first thing. But the lowest cost producers, basically the last man standing, right? So at some point, if you have the lowest cost of production, you might be the only person who's actually producing
Yep.
it economically, which is quite powerful. So I just wanted to get your thoughts on it, and I offer all of this as in the interest of complete transparency. So sell side doesn't seem to like it, or most of the sell side doesn't seem to like it.
Yeah.
I kind of like the copper trade in general on a relative basis, and I like Southern Copper based on my own analysis of the companies, and it was the reason I wanted to ask you about it because I know you used to finance these businesses.
Yeah.
So And I know you liked Freeport because of the Grasberg mine.
Yeah.
So,
I have
um,
also talked to the investor relations people over at Southern Copper as well. Um,
ah,
and so I'm familiar with them back in the day when we used to trade these over at Bank of America. Uh,
Mhm.
and uh, in any event, you know, mining has been a terrible business for the past 30 years. Gold mines don't do well, and generally speaking, go look at the price of BHP. Great company, makes money, stock didn't do anything forever. So,
Mhm.
and so let's see, we got a chart there. Go back and do a max or 5 years or a max or something.
Mhm.
Look at that.
Yeah.
I mean that's acts like dead money, but they were making money all this time, but nobody cares. Um, And if you look at a lot of mining companies, price of commodities on a real basis kind of peaked in the late 80s, early 90s, and kind of just been a hole where money goes to die.
Yeah, I should probably take a look at the total returns here because this thing actually pays a pretty chunky dividend.
Yeah.
This was a point you were making before we went live today that you were saying one of these names, you if you, yeah, I mean, take a look at this. So if you're looking at just the price chart, folks, this is a really important point, right? So you got to look at in some of these cases, you have good sort of industrial companies and the legacy businesses that operate the way people used to think about stocks. You buy a stock or you buy a bond, and you expect a good portion of your return to come to you in the form of distributions.
Hmm.
And in the case of BHP, indeed, that has absolutely been the case because over the course of the last 5 years, most of the total return that you would have enjoyed over that period of time, and the total return is about 50%. So
Yeah.
50% over 5 years compared to the S&P, I recognize that's not super exciting, but it's not terrible.
Yeah.
It's not the
Go
end of
back
the world.
further.
It's
Go back further if you would.
sure.
Yeah.
So, but my point is just pay attention to this part
Yeah.
because most of those returns
For dividends.
came in the form of dividend distributions,
Yeah.
not in terms of stock price appreciation. Over 10 years,
Well, they've done
uh,
better than I thought.
well, but it wouldn't have seemed so if all you were doing was
Yeah.
looking at the price because the stock price, 165%, not bad over the course of 10 years.
Hmm.
But if you had taken the dividend portion, reinvesting your dividends, 390%.
Yeah.
And the dividends are all indicated in blue.
Cool.
So maybe, and I guess the point is that the broader thinking here, from my perspective, is that the commodity trade, remains intact, and if you kind of subscribe to the whole notion that Mark and I have. Would it be fair to say we've beaten on this whole issue of profligate monetary and fiscal policy?
Yeah.
And I think maybe we've hit it just a little bit too hard. People are getting tired of it. It's a broken record. But I guess my point is that some of these other legacy businesses deserve a look. The prices of the commodities they sell are likely to continue to go up, at least in nominal terms, relative to these currencies. And some of these things pay big dividends, right?
Yeah.
So, and they're not trading at outrageous valuations.
Let's look at another legacy company. We talked about this one before the show, and that is GLW, which is
Oh, yeah, yeah.
um, Corning Glass. Now, they
Mm-hmm.
were a darling during the internet days because if you go do a 40-year chart or something like that, you'll see the
Mm-hmm.
stock, peaked in 2000 because the internet was going to change the world and everybody's going to get wealthy. Um,
Didn't they have an interim thing? Were they involved in the in Gorilla Glass?
I don't know.
Did they have something to do with that? Who was the Gorilla Glass maker?
I don't remember.
Um,
But in any event, this was people diving into fiber optic cable. That's what they were big on, and so that was the days of Global Crossing and some of
mhm.
other these names that were laying down cable all over the planet. And super growth business got way over its skis. Everybody bid the share price up way too high. And
They were the developer of Gorilla Glass. That's the aluminosilicate glass that is that used on smartphones.
oh, okay. So
Yeah, so that was a big.
they're making a buck from there, and maybe that's what kept them
Mhm.
alive during the the aughts and the
Wow,
teens.
look at how that thing has taken off.
But I just was made aware of this one lately, the share price taking off because um, it's getting some business for internal cabling of data centers uh, and to move data, lots of data fast. I'm going to guess they're laying down cable between data centers as well, fiber optic cable to move information around. They're being the beneficiary of it. And I'm really kind of upset that I didn't think about this um, and think about this back in 2003. Notice it hit its bottom right about a year after NVIDIA announced its super mega chips. And
Hmm.
okay, now we're starting to build out the data center. So the timing here is exactly right. Oh, okay, we're building out these data centers. Lots of demand for their product, and the stock takes off. And who
Hmm.
knew? Or at least I should say somebody did because they bought it, but
Yeah.
it wasn't me, and I'm kind of a little upset that
Wow,
I
look at that
wasn't thinking
growth. Who would
about.
have thought?
Yeah,
25% top line growth this year.
yeah. So,
137% adjusted EPS growth.
mhm.
But it's not hugely expensive. If this can hold up, it's trading at about 30 times, a little less.
Yeah, the stock was cheap. It was
27,
a
28
no.
times.
Yeah, the stock was, had a low PE because it was a slow grower. They were making some money, but they were slow growers, so nobody's going to bid up the price of the stock. And then all of a
Hmm.
sudden, they're in a new reality. And so this is a tough one now. Does it make sense to step in and buy it here? I guess if you think a lot of data centers are going to continue to get built over the next 3, 4, 5 years, then you might want to trade it. If you don't, then maybe you want to do. I don't know what you would do here. If you thought it was going to flatline, I suppose you could do some.
Sell some cash covered puts,
Yeah, you
or
could do
maybe sell some strangles against
that or
against
an
it.
iron condor. I don't know. Um, but I don't. If it's
Forty
just finding
percent.
it may just be finding a new level.
Yeah, 40% implied. I mean, it's not cheap anymore. It's not. It's not hugely
No.
expensive, but it's certainly not cheap.
Yeah.
I would think that, especially with implied vols over here, in the 40s, that maybe the way to play this would be, selling some downside premium.
Yeah.
Um,
And this.
if worst case you end up buying some of the stock, you can lower your basis steadily. If you do have the stock put to you, lower your basis a little bit, sell some upside calls, because 40% implied volatility does indeed, it does pay you back over the course of time.
Yeah.
It's not a hugely levered business. It looks like they have about $8 billion in net debt. Let's take a look here. So if one was to sell a put, and let's take a look at when they report earnings and how volatile it has been when they have. So, not hugely volatile.
Yeah.
They announced at the end of January, had a big up move here, but we haven't seen too many really big down moves.
Yeah. Lately
Um,
they've had small surprises, consistent.
mm-hmm. Yeah, yeah. So maybe let's take a look at what these. Yeah, I mean, look at the 85s give you $4.50 or almost
Hmm.
over 73 days. That's a little bit long. Let's see. these weeklies, 45 days, these do not capture earnings. If it's a stock you don't mind owning and you're not too, I'm not normally enamored of selling premium going into events.
Yeah. Well, that's the only thing I sell cash covered puts on is something I don't mind owning or would like to own at a lower price. A lot of times I want to buy it.
So this works out to.
I want to buy it instead of putting in a limit order. I'll sell a cash covered put.
Mm-hmm.
So at least you get paid for putting that order in there and backstopping somebody.
So this works out to, on a standstill basis, this works out to 24% annualized as a rate of return. Worst case, you end up put the stock at 85 less the premium you collected. We'll call it 82.5 to be fair. Give ourselves some
what's the probability
buffer for
of profit?
a transaction cost. That's a 8% discount, more than an 8% discount to the current stock price.
Yeah.
Not terrible for taking equity-like risk.
So it probably has a 60%, 65% probability of profit.
Let's take a look at that probability. It's oops, that's not right.
Now you got
it's
because you're buying.
I see what I did.
You're
I've
buying,
got
not
it
selling.
backwards. Yeah. So you have to. There we are.
Yeah.
Yeah, 72.
That's better than I thought.
72.6.
That's a pretty good.
Yeah, the probability of profit, by the way, which you can estimate if you're not using the Options Play app yourselves. Those of you who are watching, one way to estimate the probability of profit. So the probability of profit is a little bit different than the delta. So the delta, as a rule of thumb, will give you the probability that an option will expire in the money.
Yep.
The probability that it is profitable will usually be somewhat higher if you are going to sell the option, and it will be lower if you are buying the option. Why is that? Because actually the break-even point will be lower if you're selling a put, and it'll be higher if you're buying it. So you can actually estimate what that is by identifying a strike that is close to the break-even point. So in this example, let's go through that example. I think that'll be maybe helpful for folks who are trying to say, oh, well, what is the probability that I'm profitable here? So the probability of profit is basically at 82.5 in round numbers. So if there's an 82.5 strike, we can go and find that. Here's an 82 strike, and we can see that the 83s are 24 delta, and the 82s are 22. So you can say, 1 plus that delta gives me my approximate probability, which is going to be in the 70s. See? I don't know if you guys can see that right here.
That's interesting. I never thought about it that way.
So, that's just, and this is a rule of, it's a heuristic approach. If you're just trying to say fast and dirty, what's the probability I'm profitable? All you're trying to do is establish the delta approximately that you're going to be above the break point, right? Now, in fairness, using the delta of the option itself isn't a terrible approach either, because, does a profit of a penny count?
Mm-hmm. Yeah.
I mean, not really. I mean, it's we're not really interested in taking on a 45-day trade for a penny on an $80 or $90 stock, but I think you guys get the point. Just as a way to think about things, it's not a bad approach. Yeah, I think it's it's an interesting name. I wouldn't chase it here, I have to say, because it seems like an awful lot of good news has been baked into this cake. That's the first thing. The second thing is that based on what you just had us look at, which is that really long-term chart, I mean, could there even be folks who are still in this thing? I mean,
that is just... It's hard to believe somebody would stay with it that long. But you never know.
I mean, that was a speculative frenzy. I think this and Cisco, which also, Cisco only recently got back to its highs from more than 20 years ago. And the reason I like to point this out is because I think that, some folks really struggle, I imagine, to appreciate just how wild that bubble was. It lost peak to trough. I bet you it lost more than this because this is actually looking at it on a quarterly basis. 98.4% of its value. And I imagine that it's actual peak to trough because that does not look like March of 2000. And March of 2000 is when we reached the tech bubble peak.
Mm-hmm.
I'm going to guess that the real peak to trough decline was even greater than this.
Yeah.
Some of those people might have stuck with it simply because they'd lost basically everything and they figured, what's the point?
Yeah, it's
So
possible.
let's take a look at that.
But if you go back to that time period, they weren't making money.
Yeah, we're going to go like
There
this.
were people really hoping that, they'd eventually make a buck.
We're going to go like this. We're going to see what was happening in here. And take a look at what actually... Oh, I mean, we'll go from 99 to December of 2004. How's that?
Yeah.
Nice 4-year stretch. All right, so the peak was 113.33, and the trough was $1.
Oh my goodness!
Yeah, how you doing? You lost more than 99% if you top ticked that.
That's just
amazing. That is amazing. And we're getting back there. Could this be another canary?
Could be. It could be a sign of speculative froth again. It's
the thing that actually, there's a couple things that make me think we're not quite there. One of the things that you tend to see in the peak of the bull market frenzy is that everything, it's an everything rally.
Yeah.
People just they just buy whatever they can get their hands on, and not everything. Look where Bitcoin is.
Yeah.
If Bitcoin was trading 200,000 right now, and GLW was right back to its tech bubble peak. Cisco recently achieved that.
Mm-hmm.
You'd start to see more things kind of lining up. I think that would be a little bit of a warning sign. But it's good. It's good for us to have this sort of in the back of our minds, right? Because to your point, this is a name that is trading up on a similar sort of concept, which is that here's an old industrial company that is going to glom on. That's kind of unfair to say glom, I guess, but that is going to somehow participate in the newest and greatest thing because of X, Y, and Z. GLW.com, GLW.ai, like that. You sort of put whatever the latest and greatest thing is. All right, let's see if we've got some other questions in here or anything else.
Well, somebody asked about Fed funds and the Fed's rate cut.
Mm-hmm.
I think we're going to see a 25 basis point cut. I've seen some people on X make the case for 50, but I don't think we're going to 50. I think 25.
They're all hoping it in their long futures.
Yeah, but I think 25 is what we're going to get. The Fed is going to be deliberate. We don't have any real catastrophes in the economy at the moment. Employment's getting to be more challenging. I can tell you from my students that they are facing a tougher internship / first job market in a while. And then I'm guessing that companies are trying to figure out, can they use AI in some fashion to do what sort of first jobbers were doing as part of their training. And I think that's going on. And I started to talk about this earlier. This may be one of the reasons why PE ratios are higher than normal, and legitimately higher than normal, because if companies are going to um, become more efficient, they're going to grow a little bit faster. They're going to have a little higher return on equity. It's going to uh, um, support eventually support the higher PE multiples. So I think that it's where I was for a while thinking that PE multiples were too high, and we were due for a really good correction in equities. Um, I think it's very possible that companies are just going to grow into these new numbers.
Hmm.
So I think
Many
it's real
have,
possible.
many have, and some companies, by the way, they have baked in far slower growth rates.
Yeah,
I think an example would be Nvidia. Nvidia is not pricing in growth rates that persist
yeah,
at the current level. First of all, that's mathematically impossible because if they did continue to grow at the current rate, the company would swallow the economy. It would be like, there was a not a Disney movie or a DreamWorks the one with the robot that's cleaning up all the trash on a
yeah.
deserted planet Earth. I'm trying to remember. Wally.
Wally, I don't think I saw
And
that.
in the movie Wally, you have all of these remnants of the corporate culture that existed on the planet before the humans had to evacuate because we had destroyed the place. And it was the same company sold everything.
Yeah,
It was like it's sort of like in the old Bugs Bunny Roadrunner cartoons, Acme.
yeah,
The Acme Corporation. Whatever you were buying, it came from Acme. Um, if Nvidia was priced at 40 times next year's earnings, it would basically be saying, the whole world is going to have the Nvidia label on it.
yeah.
And it's not priced like that. It's trading with a 20 some odd handle. You wrote a piece, and I think you've actually written this piece more than once, but you wrote a piece. I remember a couple of years ago. You published it on the Options Edge. If you want to know what's going to happen to rates, if you want to know what the Fed is going to do with rates, look no further than the short end of the Treasury curve.
Yeah.
And so for those who are sitting there trying to figure out what they think is going to happen next, I have the 2-year up here. I believe, if memory serves, and I think you wrote that article, I'm going to say it was like could it be 5 years ago? Something like
Yeah,
that.
it's
And like I said, I know you've brought this issue up more than once. I would encourage people, just if you don't know anything else about what's going to happen and you're trying to guess what the FOMC is going to do, if you think that they're in there and they've got some magic secret super formula that they're coming up with and that that's going to dictate what they're going to do, and that you need to know how to program one of these things and know everything that they're thinking, I'm not so sure that's true. I think if you're trying to get a sense of what they're going to do, well, look at the short end of the curve.
yeah,
And it's kind of going to tell you, right? I actually think it's more predictive than... In other words, this isn't responding to what they will do. I think it is actually a pretty good sense of what they will do.
yeah.
I sometimes wonder whether they take their cues from what the market is doing more than the market's taking their cues from what they're doing.
That's what I think happens. I think the Fed follows the market when it comes
Mm-hmm.
to rates. I don't see them leading rates because if you overlay Fed funds on the 2 years, I think they match up. If you're looking at the 1 year bill rate, the bill rate tends to lead the
Mm-hmm.
Fed funds rate. So I think at the end of the day, they do a lot of statistical analysis, a lot of economic analysis, weigh a bunch of things, but at the end of the day, I think it's uh, the
Here we go. Let's
those
go.
those aren't
Let's go back a little.
those aren't lined up.
No, I didn't
There it is.
normalize them.
Okay.
There we go. So you have the 2-year rate, which floats and is based on the market prices, and then you've got the Fed funds target rate in here as well. Um, the trend that you see in the market is probably as good a predictor as you're going to find for policy rates. thereafter. And frankly, in many respects, they're the ones that are more important anyway. If you're interested in interest rates, what rates are you interested in? Like, are you interested in even, let's say, the 10-year U.S. Treasury rate, which may or may not, be manipulated by Fed policy at the longer end of the curve? Or are you more interested in, say, the 30-year fixed mortgage rate, which is probably going to have a direct impact on you? Which also, by the way, can be manipulated because they were buying things like mortgage bonds and so on. But those are the rates that are going to matter to you as an investor. Those are the rates that are going to matter to you as a home buyer, as a car buyer, anything that is financed. These are the things, the market rates, look at your brokerage account.
Oh.
What's your overnights? Those are the things that impact you. So it's as good a guide, I think, as any.
Pop in a 1 year rate just for fun.
What's that?
Pop in the 1 year rate into that chart.
Oh, okay, sure.
Just for fun.
Does it? I actually always use the 210, so I'm gonna. Let's see what the. How about it? Well, the 1 year and 1 month are going to be pretty close to one another. Let's take a look. Oh, you know what? I should have. There you go.
And then pop the Fed funds on there.
Yeah, there you go. Look at that. So I'm going to go back here to 1 year because I want everyone to take a look at this. Notice this, right? That this went down before this went down. Yeah. This went down. Well, actually, it matched it right about there.
That kind of
but now here, this has dropped below, and it precipitated what we're going to hear tomorrow.
Yeah, I think.
So what's the market telling us? It looks like a modest
I think we're going to get 20.
Reduction.
This one's not telling us a whole lot. Yeah.
But it is going down ahead.
Yeah.
So, one of the things I would say is that also, in the grand scheme of things, 25 basis points isn't that meaningful in real terms. What is probably more impactful is the sense that investors are going to get about where they stand in general. Are they going to cut by 25 basis points but make hawkish remarks, or are they going to cut by 25 basis points and make dovish remarks? Dovish, so hear what they say, not just what they do. It's a funny thing, when it comes to monetary policy, because a lot of times, as a parent, for example, we sit there and sometimes we try to tell our kids, do as we say, not as I do, right? Because maybe we don't always match our own standards.
Yeah.
If you want to know about people, though, sometimes you say, watch what they do, not what they say.
Mm-hmm.
But in the case of the Fed, a 25 basis point cut one way or the other isn't really that important, but what they say might be important.
Yep.
Because what they say can give us a hint as to what is going to come at the next FOMC. Yep. And further on down the path.
The second piece that I'm thinking about is that whether the Fed cuts short-term rates or not, I don't think it'll have any effect on long-term rates. I don't think long-term rates will go down, and I think the risk is long-term rates going up because if the Fed is cutting rates when inflation is still kind of very sticky at 3%, and the federal government's still running $2 trillion a year in deficits, so they've got a lot of financing to do. I don't see longer term rates going down, and it seems to me that they're vulnerable to rising.
I've said that on a couple of the live streams recently. I think I made another point as well, which is that I actually think the long end of the curve is going to get manipulated if we start to see longer term rates get up
by 5.
In the 5-6 area. And the reason I think that is because it actually breaks the budget.
Yeah.
You keep, if 10 years go above 6 and we have more and more stuff rolling off, we can't accommodate an 8% treasury rate.
Yeah. Paying $2 trillion
That basically means
here
that
in
every
interest.
dollar goes straight to interest expense.
Yeah.
That doesn't work.
Yeah. That's not, we don't get anything for our tax dollars. And it's an okay. So I think we're getting close to running out of time here, Mike.
Yeah. Well, on that very cheery note, no, I do think we're going to get a 25 basis
very
point
good, and
cut.
I don't think rates need to come down to keep the economy cruising along. So I just think they're gonna cut rates because that's what all the body language is. But I think the economy is doing just fine. And if we look at GDP now, I think that's projecting a 3.5–4% GDP rate.
Here's something. So someone just said, I hope I get my ulti-payment today. Robinhood said YieldMax didn't send the funds yet. So YieldMax remitted the funds as we always do. If there is an issue with dividend payments, this is not really about YieldMax funds, but the way it works is U.S. Bank is the custody of the fund's assets, and those get remitted to it goes into basically the settlement process, which is DTCC, transfer agents, and then on to the brokers, right? So there's not something where the funds withhold payment. They declare a dividend, and the custodian bank remits the payment into the settlement process. My understanding is that there are some folks at places like Robinhood that didn't get it. We don't make a payment to Robinhood. That's not how it works. Yeah. Basically the fund distributes into the settlement process, and then DTCC and all the rest of it downstream gets it out to the brokers. Why an individual broker may not have credited a distribution payment, I can't speak to that, but I will say this. You are not the first person to make this comment, and we have reached out to DTCC about this, which is the depository trust, which is part of the security settlement process. We have reached out to U.S. Bank Corp about this because they are the custodians of the assets, and we said distribute the following amount. You debited the account. What's going on? And we have also reached out to Robinhood because we understand that more people at Robinhood have made this comment. But it seems very strange to me that would only happen there. So anybody at Robinhood who says, "Oh, they didn't remit payment," yeah, that's not. Whoever says that doesn't understand securities transactions at all because that's not how settlements take place. Securities settlements, there's obviously intermediaries.
Yeah.
So I don't know what they're talking about. It's not like, oh, does YieldMax write Robinhood a check? No, that's not how that works at all. There was an old advertisement where it's a bunch of old ladies talking about putting pictures on their wall. Someone says, "Oh, I posted a picture to my wall," and she has a wall like in her house, and she's got old pictures, and she's putting them up, thinking that that's the same thing as posting pictures to like a Facebook page. That's not how this works. It's not at all how this works. But it is important, and so we are looking into it for sure because I don't understand what the problem is. So someone else here is speculating that the brokers are making a buck. Let's see here. So brokers making a buck on a 1 to 2 day delay. It's a funny thing because in the context of rates, floats begin to make a much bigger difference in this business. What's the float? This is basically how much money the institutions that have people's funds make in interest on those funds. Now, for a fund manager, it makes none because to the extent that you have money that's in cash or not in cash, that goes to the benefit of the fund shareholders. But if you have a brokerage firm and let's say you're earning 3.5%, but you're paying 2.5%, you have a 100 basis point spread. That can make a big difference. That wouldn't be the case here, though, because the brokers are not allowed to just simply delay the settlement process. You can't just say, oh, well, securities transactions usually settle in T+1, T+2, T+3, depending on the nature of the transaction. But a broker just says, well, I'm just going to delay this and hang on to the money so I get the float. Yeah, they can't do that either, because the settlement process is also, that's dictated. It's not up to a broker to say, oh, well, sure, it's T+2 or T+1 for settlement at that bank, but we just take a little longer. Mm-mm. Yeah. No. You don't get to do that. So it is. We are digging into this because this is very strange. And by the way, anybody who has funds where you've gotten delays in distributions at one institution and not the other, or if you have received it on time, we're very interested in hearing all of this because we're trying to chase it from two directions. We know when the money went out, so when people didn't get it on the other side, if anyone did, we want to know why they did and why others didn't, right? So this is all very important to us, and so if you have any thoughts on that, by all means, send it along. But yeah, the brokers aren't allowed to just to delay settlement for their own purposes. My guess is, so someone's saying that it might be at Schwab too. I think I actually heard that. My guess is that there were a couple things that were all going on at once. First of all, a lot of funds distribute on a weekly basis, but there was a Thanksgiving in there and a half day. Is it possible that that introduced a little bit of a delay? It's possible. Our objection is that if we instruct a distribution, we have there's a record date, there's an X date, there's a declaration date, and there's a pay date, right? So the record date and the X date are usually about the same. That is, if you own a security and you are the holder of record on the record date, then you are entitled to the dividend, and somebody who is not the holder of record, so if you buy it after the X date, you will not be the holder of record, then you're not entitled to the distribution. So that matters a lot. Declare X record and then pay date. And the thing is, if we had known that there was going to be some kind of a settlement delay in the distribution, we would have informed a change to the pay date, right? So for our perspective, the pay date is going to be when we remit plus whatever the amount of time it takes those transactions to settle. So if a transaction settles in T+1 and we remit, let's say we send a distribution for $100 million in distributions, and there's a T+1 settlement, we expect people to get the money the following day, which will then be the pay date according to our declaration of the distribution. Yeah. So this is a very curious thing. Obviously, we can't change when Thanksgiving happens, but that should not, as far as the settlement process is concerned, if there was going to be any delay, they should have let us know. But we want to get to the bottom of this for sure. Anyway, I apologize, it's not really a topic for office hours necessarily, although it can be interesting because Mark and I have been in the business for a long time in a number of different contexts. And, periodically we do see settlement issues, but I'm very interested in learning more about what might be causing this one. All right, well, Mark, I know we're going to be having the holidays coming up, but hopefully we'll be able to have another conversation this time next week. Are you around?
I am around, yep. I'll do it from home next time, so we'll get the 4K camera on this.
Oh, when does Rutgers kids, when do they all go on vacation? You've done all of your finals and stuff like that for the semester?
I have one more final to give tomorrow, and then after that I'll be spending time trying to figure out.
Grade them?
The grades that I'll finally hand out, yeah.
Okay. All right. Well, great. I look forward to office hours next week. For those of you who tuned in, thank you very much. Like, subscribe, send us your questions, put the chat in, put it into the chat, and hopefully you can tune in next week when we do another one of these.
Cool.
We'll see you soon.
See you.
Thanks for watching.